Hi ladies and gentlemen, this is Game of Trades, and this is going to be a technical analysis of the S&P 500. So we got the pullback that we were looking for. What is next for the stock market? Things got too easy. Everything was going up. Everyone was making money, making profits. Brand new traders in the investing community had found the secret to being rich. You just have to go long. Now the markets have retraced all the gains made in the past 2 weeks. Has the bubble really popped? Has the Fed rally really ended? Or is this just a minor pullback, part of a much larger inflation of prices in the stock market, fueling an asset bubble in the coming years? Let's answer that in this video. So first of all, let's take a look at the nature of this topping pattern. This is what's called an island top reversal pattern, because you have a gap up, you have a few candles, and then you have a gap down. And so it looks like an island. And we've talked about this many times on this channel. These types of patterns come at the end of an extended uptrend. And so this is exactly what this is. We had the extended uptrend and then the island top reversal pattern. And so this is a very high probability pattern. Traditionally, in technical analysis, you start shorting right at the gap down. And so you would have got this entire move down with a stop loss around at the top of the gap right here. So what it basically does is trap people, because when you have an uptrend like this and then you get a gap up, people get excited, especially new investors. They jump on the train after that gap up because of how bullish the market is. And then the markets gap down against their position. And so that basically gaps past their stop loss and leaves them trapped in their long position. And so typically a new investor will wait for the markets to come back to that valuation so that they don't lose money, but they just see the markets get redder and redder as the day goes on or as the week goes on. Now make sure to like and subscribe if you enjoyed this video, and don't hesitate to drop a comment below giving us your thoughts on where the markets are going. And so you can see we have wiped out, we can measure, we've wiped out around 2 weeks of trading, 19 days of trading, so almost 3 weeks of trading with just a couple of candles. And so anyone that was invested throughout this entire run up is now underwater. And that is typical stock market action, trying to shake out the retail investors, shake out the hype, which was clearly getting out of hand. And so if you're a new trader and you're watching this video, really try and not make the same mistakes that others are making. Don't go with the mass. Have a trading strategy with a favorable risk-reward ratio. This is something I was talking about on this leg up here. There was just no upside left to this move up that could happen without getting into historical readings. And that's what we did here at the top. We looked at the put-call ratio. I'm going to show you that chart. We had the put-call ratio right here at a historically low level. I think we've only had around 2 of these in the past 10-15 years. And so what this meant is that everybody was going long and nobody dared to go short. And so if you go against that large majority, when you get these kind of extreme readings, you're likely to do very well. And that's exactly what we did. We shorted on the break of trend line and got a nice short trade. And we did the same thing in March right here with this reading. There was extreme fear in the markets, and so we went long and did quite well. We did the same thing in February with this reading here, and you can be pretty much successful with any extreme reading on the put-call ratio. This is a very high probability trade just because of how rare these kind of readings are. Now going back to the S&P 500, as I was saying, we got the sell signal on the break of that trend line, and we had our target set at the 3,000 point level, which we tagged yesterday and we tagged again today. So we got that pullback. So what next? What's going to happen in the coming days? How is the stock market going to look like? And to answer that, we're going to take a look at the volatility. This is the VIX, so it measures the volatility of the S&P 500. And so what it basically says is that when volatility is high, you're going to get big moves in the market, and that's typically when the markets go down. And when the volatility decreases, that's typically when you're grinding higher. So low volatility is synonym of bull market and upside. And so I was watching this watching the VIX start to come down to this support level. And this just shows you how well technicals work. I mean, the VIX just came down all the way to this support level with all of these reactions, and it bounced straight up, broke out, and we had that big red day right here with the volatility increasing. So we are at very, very high historic levels of volatility. We can zoom out on the chart. Let's take a look at the weekly chart. And you can see this is where we are. And there have only been a few periods in history with volatility that high, and that is during bear markets. So get ready to see a lot of big moves in the coming days, whether that is to the upside or to the downside. We're going to see some big price action. And so again, if you're a new investor, be careful. The volatility in markets really likes to trap new investors. It's very easily to get chopped to pieces in a volatile market. So keep your position sizing reasonable. Now the big question is the market finally going to start pricing in the economic downturn that we've seen, or at least the economic downturn that we're bound to see with everything that happened in the past couple of months? Will the stock market reconnect to reality, or will it stay in a big bubble? Because whether you like it or not, prices are hugely overvalued. And we can look at that with the PE ratio. This is the PE ratio of the S&P 500, and you can see it's absolutely skyrocketing. You can think of the PE ratio as a measure of how overvalued or undervalued a particular asset is. And so it's the price divided by the earnings. And when you get the earnings that completely crash, like they did in the past couple of months, but the price continues to rise, you're going to get a big move up like this. And you can see we're at similar levels to the dot-com bubble right here. So we are really in bubble territory by definition. But the problem with bubbles is that they can last a lot longer than you might think. And I'm going to show you another chart to show you that. This is the NASDAQ 100 index. And so it's the tech ETF. And so this is a chart of the dot-com bubble that burst in the year 2000. But the problem with that is that people were calling this a bubble back here already at the end of 97, right here, with the impressive gains we had in tech during this time period. And so they were completely right. This was a bubble, but they were way too early. And the markets actually continued on higher from that point on all the way to the top for another 400% gain. That is massive. And so if you're able to take advantage of that as a trader, as an investor, you can be very profitable if you're able to exit out successfully and in time. And so the real question is, when does it pop? So going back to the S&P 500, the Fed has clearly proved to us that they do have an influence on the markets with liquidity and low interest rates. And they have that influence despite very, very poor fundamentals. And so that was something I was saying back here when the markets was a little bit more reasonably priced, when we were still in the bear market rally scenario. I said there was only so much the Fed can do for a stock market with very poor fundamentals. And that was clearly an underestimation. This is a breakout that we would have never gotten had the Fed not been intervening. And Powell confirmed they'll keep interest rates at zero at least until 2022. He said they're not even thinking about raising interest rates. So that tells a lot about the next few years in regards to their monetary policy. Not only that, but the S&P 500 is more top heavy than ever. There's 5 stocks doing all the heavy lifting. I showed a chart in my last video. I'm going to show it again. Tech is starting to become an increasingly big part of the S&P 500, very similar to the levels that we had during the dot-com bubble. And so this pullback that we're seeing right now and that we're likely to see in the next couple of weeks is really going to be the test to see how much the Fed really is in control of the markets. We've seen the bulls do their thing, and now we're going to see the bears do their thing. And by the way, in regards to the short trade, if you're short on the S&P 500, you can book profits at support levels and short at resistance levels. We have a strong crossover on the MACD. But again, make sure to lower your stops along the way to book your profits. That's one big rule in technical analysis. Cut your losses with stop losses. That's what we did on 2 or 3 separate occasions on this run up. But let your winners run. Lower your stops along the way and let your winners run as long as they can. Now, if you're not yet short on the S&P 500, starting a new short position right now is much less favorable than it was back here. We've got huge support levels. We've got these moving averages, exponential moving averages right here that are acting as support. We've got this consolidation zone right here that's going to act as support. And we've got this big trend line here that goes back 11 years. This is a bull market uptrend line. That's also a big safety net. So I highly doubt that the markets are just going to be able to slice through all of that. That's a very improbable scenario, but if it happens, that is very, very bearish and could signal much more downside in the future. But again, that's not my favorable scenario. Right now, I'm letting the short trade run, and we're going to see what levels hold on this chart. And if you think that this is going to be a big bubble in the stock market in the coming years, then there is no better time to start going long right now. You've got a big safety net right here with a bunch of support levels and a big trend line here. So you can cost average down on positions here for a big bullish position that may go higher in the coming years. And that is definitely something that I think is reasonable to do. I don't think anyone really has an answer for what's going to be happening in the next few years. But buying in a few well-performing stocks on the way down, cost averaging on the way down for a long-term position in your portfolio is frankly potentially not a bad idea. And you can, again, this is a safety net. So if the markets start breaking down back below this trend line, you've got a stop loss right here. So to put it simply, this is really not an easy video to understand. We were short here and we're letting our short trade run, but I suspect the market is going to start getting very choppy if it starts getting into this area. So again, if you're not an experienced trader, trying to fight your way through this complicated market is going to be very difficult. So stay cautious in this volatile market. Use appropriate position sizing, stop losses, and a proper trading strategy. Don't buy into the hype. We all know how that ends. And that's pretty much it. I hope you guys enjoyed. If you did, make sure to drop a like on this video and subscribe for more content. In the meantime, good luck on your trading and see you next time.